stocks and help you pick the right stock at the right time.
Welcome back. You're watching Indian Open right here on Bloomberg Quint. Remember, we are coming off a holiday, and today we're going to be keeping a track of what's been happening in the last 2 days of trade across Asia as well as the US market. So tepid trade across the board. In the US, obviously, you did see a slump coming in across the board for the S&P, Nasdaq, Dow Jones. Fourth straight day of losses for Asia as a pack, barring a Nikkei, which is up marginally by 0.1%. There are cuts in Shanghai as well as Hang Seng, which is down about 0.5%. For the SGX Nifty, we're trading under by about 0.25%. 11,407 is where we are currently perched at. Well, the Turkey contagion not just scares people in the equity market, but is causing investors to take a flight from the commodity market as well. As you saw, the last 2 days have not been particularly good for metals like copper, aluminium. Even some of the precious metals have seen an undercut over the last few days. The Turkey contagion really messing up with prices across the board. Copper under 6,000 per metric ton, $6,000 per metric ton. That's actually looking like it could move into a bear market. Let's get in a better sense of what exactly this holds for our markets in terms of what kind of further pressure we can expect from the commodity space with regards to this. Kishore Narne, Associate Director, Commodity and Currency at Motilal Oswal, joins us on the phone line right now. Kishore, thanks very much for talking to us. What is the broader implication of what we're seeing over the last 2 days of trade in global commodity prices? Copper and looks like could enter into a bear market. Aluminium slid 2%, zinc slid about 3%.
Yeah, good morning. I think, see, as you mentioned, yes, copper is now almost down 20% or more, and zinc, nickel, aluminum, I think nothing to spare. Most of the commodities, including crude oil, is seen price weakness, primarily because of dollar strength. So all the commodities which are price quoted in dollars normally become weaker when the dollar as a currency strengthens against other major currencies. So that's a mathematical explanation of one side. The other side, of course, is that the worries that the ongoing trade war and the kind of European issues which we are seeing post-Brexit are going to slow down the global growth and eventually the consumption slowdown which is going to happen. I think that is one of the most worrying factors rather than the short-term currency blips which we have seen. So I think if we are looking at the global consumption growth of commodities have been considerably falling, including in China. I think that is one thing which is worrying the commodity traders a bit, and that also implies that global growth is a big question mark on the sustainability of the global growth. So if that all happens, then that's also indicating that the investors are fleeing back to the safe haven currencies like dollar. So it's a vicious cycle which is feeding on itself, that contagious effect of Brexit and trade war, which is hampering growth, again making dollar stronger and making commodities weaker in dollar terms.
Year to date, 20% slump in copper is what we're seeing. 83,000 copper futures shorted by money managers, over the last 2 days in the global commodity market. Just want to track the copper chart. We showed that copper chart, a bit back, where it's actually tracking the fall in the Chinese yuan. So you can see pretty much tracing the line for both these, for the yuan as well as for the copper prices. More pain, more pressure left here, more selling to come about?
Yes, maybe. I think maybe we might see, we have actually seen some consolidation towards around mid-July to beginning of August. Again, the fall resumed last week. I think we could safely say that another 8 to 10% fall could be there. That should be taking copper to around 5,200, 5,500 levels. But some of the miners already started to seeing that pressure. Already we've seen a couple of strike calls coming up from South America, especially from the Escondida mine. That's the world's largest copper mine. But they just avoided a strike. They were successful in that. But I think as we see more and more pressure, some of the supply side can shrink, and that should actually stabilize the prices. At this point of time, there is no real supply side shocks. The only thing which is driving is the demand side and the sentiment from the currency markets. So at this point of time, I believe probably we will be going down to around $5,500 before we turn around in copper.
All right, Kishore, thanks very much for joining and really appreciate you taking out the time and putting things into perspective for us. So still more pressure left. You tracking the currencies, particularly, Neeraj, to see what's been happening globally as well, and our currency as well. We know what's happening. But you remember, you had the Economic Affairs Secretary saying that it's okay if it crosses even $80, 80 rupees to the dollar for that matter, unless it's doing it in tandem with what the rest of the emerging markets are doing. So
yeah, but it will bring about some discomfort really if that were to happen. But currently at about 70 to the dollar. Commodities though, slumping in trade. Parthiv Shah, director at TRACOM Stockbrokers, joins us right now on the show. Parthiv, good morning. Thanks for joining in. Just wondering, commodities are getting punished. What's the impact on some of the commodity-based stocks back home?
Good morning, Neeraj. Neeraj, if at all I were to talk something positive related to this commodity meltdown, my interaction with many of the corporates, especially some of the SMEs and MSMEs, I think which are the backbone of your economy, I think certainly they would be happy with all these industrial commodities coming down. One fear that they had was working capital was getting tighter, and the reason for them for the requirement of higher working capital was not only higher capacity utilization, but also because of inching up of all these industrial commodities. Now things like copper, zinc, nickel, and now even oil, all of that cooling off in an environment where our currency is depreciated. I think it's not a bad scenario for many of the corporates in our country. Yes, one might argue that big players like say Vedanta, Hindalco might not really like this, but again, they are very huge companies, they are cost leaders in their respective segments, so I'm sure they're not going to really compromise a lot in terms of the spreads that they earn, which is far more important in many of these commodity-based companies. And I think most of them are not doing any major inorganic acquisition, which should have any sort of worry in terms of their balance sheets. Rather, they have been cutting off debts. Even Hindalco, I think, despite the recent acquisition that they had, that's value accretive. So overall, I think I'm not really worried that this scenario is taking place, and it's proxy to the dollar strengthening. So I think overall, I believe it's quite positive for many of our corporates, and very happy to see how oil has slowly, gradually started coming off. Brent being at 4-month low bodes extremely well for our economy, for our macros. So I think at a point in time where our micros, especially in Q1 FY19, if we were to see, and even if I were to talk about the Nifty-based companies, including a name like say Tata Motors and some of the elevated provisionings that the banks have done, I think the earnings growth, the core earnings growth has been at around 27-28%, and on an operational EBITDA front, that's around 34%. So I think very encouraged with the micros and the overall industrial growth taking place. Yes, we need to monitor the global macro front, wherein how bad the scenario Turkey gets. Capital controls, if at all were to come, one will have to be very, very cautious. But so far, so good. I think nothing really serious in terms of the global setup disrupting our markets.
All right. Just stay on with us, Parthiv. We'll come back and talk about the Nifty and what exactly are the stock picks that you are recommending. But before that, our research team is here with us. We've got some stocks and news to watch out for. Still, though we are fagging of the earnings season, more numbers to watch for. Let's start off with you, Shraddha. First, some stocks and news.
Yeah, so I'm going to start off with the weak numbers that were reported. GMR Infra is at the top of the list. Revenues fell by about 35%, and the net loss widened to 135 crores. EBITDA margins came off to about 25%. That apart, GMR Infra has also said that they've executed a settlement agreement with the PE investors. This is specifically for its airport arm. And additionally, they're also planning to raise nearly 3,000 crores via debt and equity issuances. So let's see how These two will weigh on the stock. Cox and Kings is another one on the list. Revenue growth of 14.5%, but despite top line growth, the net profit has fallen by a sharp 56%. That was impacted by operational performance, where EBITDA fell by 20%, largely on account of a big jump that came in on the other expenses front. Indiabulls Real Estate revenue growth of 38%, but despite that, the net profit has fallen by about 5%. EBITDA margins have also come off from nearly 55% to 30%. And finally, Fortis Healthcare, where revenues dipped by 10%, and it reported a net loss of 70 crores for the quarter as compared to a small profit in the year ago quarter. EBITDA has also come down by about 90%. That's largely that's the operational performance, and fall in other income is also being attributed as one of the reasons for the net loss. But shareholders have cleared IHH proposal to buy the company.
All right, Shraddha, those are some weak numbers. For some strong numbers, Agam is here with us.
Right. Well, I have 4 stocks on my list. Let's start off with SP Apparels, and we've seen about 27% growth in its top line, profit rising by around 13.5%. We've also seen an expansion in margins at around 14.9% as against 12.5%. Next up is Aster DM Healthcare. That's where we've seen about a 14% rise in revenues. Net profit at around 12.4 crores as against a loss of around 76.9 crores, and that's where we see a big difference. We've also seen margins coming in at 7% as against 2.6%. Suven Life Sciences, there has been a substantial jump in the top line and the bottom line of 36% and 31% respectively. However, there has been a little bit of contraction in margins at around 30.4% as against 32.1%. And well, strong earnings for Dilip Bilcon as well. This is largely perhaps to a certain extent on expected lines. 46% rise in revenues, net profits doubling to around 255 crores, and margins remaining largely stable at around 17.8% as against 18%. So 4 stocks which are likely to open positively on the back of earnings.
All right, those are some earnings coverages. We've got a few individual stocks also that we'll watch out for their news.
Yeah, so we'll start with the index heavyweight Reliance, obviously. So there the news has come that the company has shut down one of its FCC units at Jamnagar complex to assure reliability and integrity of operations. Now the unit is expected to start operations within a span of 2 weeks, while the company has not given a proper reason for specifying the nature of the issue. Also some corporate action coming in from Jindal Worldwide. So there the board has approved a stock split of 5:1. Gati is back in focus on the back of an ET report suggesting that All Cargo Logistics is in talks to acquire a controlling stake in the company. Now remember, just last month there were reports suggesting that TVS Logistics too is in talks to acquire the promoter holding in the company for about 1,500 crores. So that is one stock which would be moving today on the back of that news. And also we're looking at KNR Constructions. There's a Financial Express report suggesting that the company is in talks with Cube Highway and Canadian asset manager Brookfield to sell its entire stake in 4 hybrid annuity model projects. Now the enterprise value of these projects is estimated to be worth about 4,000 crore rupees.
All right, lots of stocks there to watch out for. Thanks, guys, for joining in and highlighting all of those stocks for us. Parthiv, just want to come to you on your individual stocks and what's, according to you, your call on them.
See, I think one of the stock and one of the theme that I'm really starting to like is the domestic pharma theme. And we saw recently many of the MNC players, I think they have started reporting fantastic set of numbers, and the domestic growth story, even if you were to compare in terms of results that Cadila reported, Sun Pharma reported, and the growth that they've shown in the domestic front is extremely encouraging. So I think we believe that it's not a bad idea over the next 3 to 5 years to play many stocks in the pharmaceutical space which are focusing on the domestic story and slowly and gradually building up their US-based export story. So one stock that comes to mind is LKM Labs. I think this is a great stock in terms of understanding and owning the domestic pharma and the branded solution space that they're offering. I think they have a fantastic market share. The growth has been extremely encouraging. They've held up their margins quite well, and whatever small portion of their business comes from the US markets. Recently, it was quite encouraging to see an EIR that they received in one of the US FDA approved plant. So I think slowly, gradually with the currency depreciated, I think they can really benefit in terms of their export story. But more importantly, I think they're razor focused on the domestic growth story, and I think the numbers can start coming in terms of very positively surprising the street. So I believe that Alchem Lab can be a fantastic stock to own at current juncture, and one can ride this story for at least next 2 to 3 years.
Okay. So watch out for Alchem Labs as well in the session today. In moments from now, we'll of course get in Yash Upadhyay to talk about what the Bloomberg edge is showing. But before that, Parthiv, stay on, so much more to talk about. Let's get in Sameet Chavan and Rahul Mohindar. It's 8:49, above time from where we usually talk about technicals. Gentlemen, both of you, good morning. Thanks so much for joining in. Rahul, does it seem like the party is likely to pause? If you were to take a fresh trade, either options or futures, would it be on the short side on either the Nifty or the Nifty Bank?
Good morning to you. First of all, I think you correctly used the word pause. I think we need to understand that the construction of this uptrend is fairly solid. We've just seen a 2-day dip. That's not good enough to conclude a medium to long-term breakdown. I don't see any clear signals yet. I'm not saying that it probably will not happen, but I think there have to be numbers to back it. So what would I look at on the Nifty? I would continue to maintain a bullish or a hold view from here, keeping 11,330 as the key support in mind. For those who are intraday or very short-term traders, I think the next gush up can only happen if we can surpass 11,470. What's the point I would worry about shifting trends? The earliest would be a break of 11,330 on a close. I'd look at some key heavyweights also breaking down, things which are holding the index up, something like a Reliance. Reliance breaking a level 80 or an SBI breaking a level 290. So very important to watch that these numbers break down the system.
Okay. Sameet Chavan, good morning to you. How are you approaching trade today?
Good morning. We have been, witnessing some kind of consolidation, but if I have to take a broader view, then our view still remains bullish, and we are in a, kind of buy on declines kind of market. I would like to highlight one point here. I have been receiving calls since last one day that the people have been trying to find out some kind of correlation with Hang Seng and other international markets. So I was just going through their charts, and I clearly found that Hang Seng has been clearly underperforming in last 1.5 months, and we are around our record highs, and it is nowhere near to its record highs. So that's a sign of strength. So I believe that at least in the near term we don't see any kind of direct correlation with the Hang Seng or other emerging markets. Probably we may have a catch-up move or not. I'm not sure about it. But as far as our market goes, we still believe that the downside is limited in case of correction. Also, 11,250, 11,300 are likely to act as very strong support levels. So as far as trade goes, in case of gap down opening, if we see Nifty somewhere around 11,370, 11,380, then that would be a buying opportunity. Risk reward would be favorable. I believe that 11,340 would act as a support, and we would again reattempt to surpass 11,400 or reclaim 11,450. So as far as bias is concerned, we still remain positive on market.
All right, there's still a positive bias there, and not a very big dip expected even on corrections. Let's move on to a special segment before we go and address pre-open. We've got Yash Upadhyay joining us to tell us what pattern the Bloomberg terminal has thrown up this morning. I believe it's a stock on the negative side, Yash.
That's right, Devina. Good morning to you. So Bank of Baroda is what we are looking at the charts today, and that one has slipped below the MACD line. That one has slipped below the signal line to generate a sell signal. So before going forward, let's understand what the MACD indicator is. It is basically a trend following momentum indicator, which shows the relationship between two moving averages, and it helps to identify the change in a trend. Now, how do you interpret it? It's simple. It generates a bullish signal signal when the MACD line that crosses above the signal line, indicating to buy into the stock, and while it gives a sell signal when the MACD line that crosses below the signal line, which is in the case of today's chart, which is Bank of Baroda. So if you take a look at it, the MACD line, which is the one in blue color over here, that has fallen below the signal line, which is the one in white. And now it's always best to use the MACD in conjunction with a moving average. So yesterday, which was actually Tuesday, the stock has closed below its 200-day moving average. So that indicates further weakness in the stock price.
All right, and how reliable is this indicator?
So over the last 1 year, it has given a positive hit rate of about 35%.
All right, not bad on that one. Bank of Baroda, though, year to date, not doing much actually, down marginally by about 0.5%. The stock probably, one of the underperformers, at 146 on the stock. Sameet, let's take some of your top calls.
See, on Tuesday, if you see, pharma stocks were on a roll, and if I just look at the Nifty Pharma Index, it has confirmed a breakout. So we believe that pharma stocks are likely to provide better trading opportunities. Vocard Midcap Pharma, which has been underperforming, but since last couple of days, we have been witnessing some kind of buying interest at low levels. So we would go long in Vocard for target of 654, stop loss at 582. Apart from this, if I just look at the Nifty Midcap 50 Index, it has clearly confirmed its higher top higher bottom formation. And we believe that there's a long way to go as far as mid-caps are concerned. So we have a buy on Amara Raja, which has already given a confirmation of breakout from its recent concession zone. Volume activity has picked up, so we believe that this stock is likely to move higher. Target 900, stop loss at 814.
Rahul, your top calls?
I would look at buying Yes Bank. I'm still bullish on banking. On the stock, I'm looking at a 402 near-term target. Of course, if the banking rally moves up further, we're looking at 430, 440 as well, medium-term. Stop loss of 370 here. Amongst the weak set of stocks, I've continuously disliked L&T. L&T has been on my sell list for a long bit. 1235 for those who are short-term traders, that's the target. However, I still see it sinking to about 1190 given a few days. So keeping a stop loss of 1275, I'd go short on L&T.
Parthiv, you would have read the news on Kotak Bank. What's the impact on the stock, not just today really, but over the near term until this 10% stake sale, assuming that's the way it goes ahead, of course, that this 10% stake sale goes through? What's the overhang on the stock? What's the impact on the stock?
My sense is that yes, they're certainly going to challenge SEBI and try and challenge RBI and try and I think get their deal done. One concern is that yes, it could be slight overhang on the stock. It would be a wonderful opportunity for one and especially long-term investor to accumulate this stock on any declines. And I think what we have understood is that Mr. Uday Kotak is certainly not in the mood to just sell off his stake in the market and encash it. He's extremely upbeat in terms of the growth prospects, and this being a $35 billion enterprise, even a 10% dilution comes to around $3.5 billion. So I think next, the plan B, what I assume, is certainly going to be some sort of M&A activity. And yes, I think they are fantastic capital allocators. They know the right strategic fit in terms of what would be the best M&A that could work out. And certainly it doesn't seem that even RBI is in the mood to allow them to get it so easy. So I think it's going to be a very interesting battle going ahead. But it seems that, next plan B is certainly going to be an M&A activity, which probably the street won't certainly mind with the pedigree that Kotak Mahindra Bank has and their past track record of M&A, wherein they had purchased ING Vysya Bank. I think it had a fantastic integration story. So I think any sort of decline due to this recent news, I think we would certainly be buyers in this. Certainly the stock is not cheap at 5.6 price to book. So any sort of decline would certainly help alleviate some concerns in terms of the valuations. Though it's not going to be cheap even after the correction. But looking at the long-term growth trajectory that this bank brings along, and any sort of good M&A activity will certainly help the return ratios going ahead.
That's Kotak Mahindra Bank. This year, the stock's down about 27% though for the month. It's down closer to about 9%. The other stock to talk about is Sun Pharma. The street cheered the kind of numbers it posted, turnaround in terms of the US revenues, growth from the India business, 28%. If you remove Taro, their standalone numbers were even better. They've got a lot of specialty products in the pipeline, 2 coming out from Halol. So all of that probably could see, the stock probably go up further. On the charts, however, a big move on Tuesday's session. Sameet, you're tracking Sun Pharma?
Yes, I've just highlighted that, on Tuesday, the entire pharmaceutical pack was on a roll, and Sun Pharma clearly was, one of the outperforming stocks. There has been a series of hard bottom formations since last 1.5 months. Recently, there was a consolidation, and on Tuesday, we did witness a decisive price volume breakout from this consolidation. If I just look at the volume activity, it was clearly sizable. So I believe that this momentum is likely to continue. The stock is clearly heading towards 645, 650. One should trade with a positive bias, and now earlier, resistance level of 580, 585 would act as a very strong support.
Okay, less than a minute to go. Parthiv, 30 seconds though, very close to pre-open. But if you were not holding Sun Pharma, would you buy it post the numbers on Tuesday?
See, I would wait for a dip, frankly, because no doubt I think the results and all the green shoots that we heard about from the management post the results were very encouraging. But certainly all the new launches will bring in elevated cost, which might impact their margins going ahead. So maybe the street might not be extremely gung-ho post these numbers, but on any declines levels 550, 560, certainly a buyer over the next 2 to 3 years.
All right, 32 seconds left to go for market pre-open. You're going to be watching out for many more stocks as we open the session today. We've been coming off a holiday, so the moves, will be keeping into account the trades that we've missed over the last 2 days. Asia as a pack, a mixed bag there. Nikkei marginally higher. Shanghai has lost a little more steam, about 0.8% lower now, and Hang Seng is down about 0.6%, 170-point cut. SGX Nifty trading in the red by 1/3%, 33 points down, 11,400. You should have the pre-open ticks up on your screens right now. Opening flat, slightly negative, 6 points lower on the Nifty. Juggling between the positive and the negative right now. Sensex at 38,000, 142-point increment there on the index. So you are looking at the prices being all over the place currently, but Axis Bank is showing you a 9% move, in fact a 10% move, but that will stabilize. Asian Paints is up about 4%, HPCL is up about 2% Eicher Motors, Coal India, Cipla, Tech Mahindra, IndianOpen Bank, Bharti Airtel up about anywhere between 0.7% to about 1.5%. I think we should just watch out for the rupee as well. 70.24 is where we've opened at for the rupee. So, it looks weaker in today's session once again, about 0.5% dip coming in there. Remember, you had the July trade deficit numbers coming in at a worryingly high level, taking it to about $18 billion on a year-on-year basis. Trade deficit came up to about $6.6 billion for the month of July at a 5-year high. There were no clear one-offs, so the likelihood of this continuing stays, which could be, a cloud that weighs down upon the currency as well. Well, this may be good for the export market, but just right now, looking at what's been happening on the macro front, at least it looks a little bit shaky. 70.26 on the currency.
Okay, the bond yields steady though in the session today. What else? There's some moves that are coming in stocks like HDL and Rain Industries. Remember, Rain came out of a fairly decent quarter, and maybe the stock is duly reacting on that front. Some strong results. Just want to mark 2 or 3 names out there. There were Dilip Buildcon, which came out of the strong set of numbers. Aster DM Healthcare, fairly decent set of numbers. Maybe those stocks are reacting. 4.5% for Dilip, 3.5% for Aster DM. Cox & Kings had a fairly wobbly quarter, likely to react negatively. About 1% lower, nothing too dramatic though. And last but not the least, just want to see if the action is continuing in Sun Pharma. The party began Tuesday afternoon with a very strong quarter. Seems like starting off on a good note. Let's get in Sameet Sircar, who joins in with the top brokerage calls for the day. Good morning, Sameet.
Good morning, Neeraj. On the big brokerage calls for the day, first we have is JP Morgan on Mindtree. Now, the brokerage has initiated coverage on this stock with a neutral rating and a target price of 1,050. Now, according to the brokerage, Mindtree has carved a strong positioning for itself in the digital service business. Now, company's RUN business is not only complementing the digital business but also offering revenue stability for the company. Now, the brokerage is expecting the company's revenue to grow at a compounded annual growth rate of 16% over FY18 to FY20, and along with this, rupee depreciation will also lead to a strong earnings growth for the company going forward. However, despite this positive, the brokerage is assigning a lower valuation multiple to Mindtree on account of the margin volatility seen in the past and because of the client concentration of the company. Second, we have is Deutsche Bank on UPL. Now, the brokerage has maintained its buy rating on the stock with a target price of 765. Now, according to the brokerage, 1% USD appreciation can reduce its post-acquisition EPS by around 4%. Now, this currency volatility in emerging market is a worry, but a risk-reward remains favorable for UPL, says the brokerage. It also says that the new Arista acquisition has increased the currency risk for UPL, but the current valuation is pricing in this risk, according to the brokerage. However, the brokerage has maintained its positive stance on UPL as it is expecting the company's FY19 revenue to grow around 12% from 6.5% seen in FY18, and is also expecting the company's margins to expand, driven by the backward integration plans of the company.
Okay, Sameet, thanks for putting that into perspective. So, a couple of names to watch out for in the session today. What started off well, Rain Industries up another 5%. I know Parthiv tracks it very closely. Parthiv, were you happy with the numbers? The stock reacted about 5% in Friday's session. Another 5%, seems like we'll start off another 5% in the session today as well.
Yes, Neeraj, certainly. I think it was really hammered very badly, and I think with the numbers being very, very encouraging. And one slight concern that the street had about this company was the elevated debt levels, and with the good realizations that they were earning in CPC. And I think the very strong demand and all the bookings that they talked about with most of the aluminum majors world over, I think being very strong, I think gave very good visibility about the earnings for the rest of the FY19. And with good earnings and good cash flows and no capex coming ahead, I think the free cash flow generation would have certainly helped, I think, going ahead to reduce their debt. So that is the story the street is certainly wanting to bet on. Post the massive decline that the stock had from its elevated levels of upwards of 300, I think the stock had become extremely cheap and compelling. And now with good numbers and reconviction that the management has given post the numbers in terms of their commentary, we are seeing again a buying trend taking place. Yes, the ASM thing was certainly a distraction, negative one for most of its shareholders, but now it's good to see that the stock is bouncing back. And I think it's extremely well placed the way it is, and I think most of its assets internationally is also doing quite well.
Jet Airways is also bouncing back in today's session, 290 on the counter. Remember, we spoke about how Blackstone has showed some interest in picking up stake in its loyalty program, Jet Privilege, to the tune of about 3,000, 4,000 odd crores. But that is dependent, obviously, on the fact that Jet Airways, secures funding for its airline operations. Parthiv, what did you make out of Jet Airways?
It's a total avoidance. One reason being, I think it's been struggling even when the crude prices were lower. If I were to just compare its non-fuel expenses, they were most elevated in the industry. And now with the recent trouble that they're facing, and even if some PE investor were to kind of buy some stake in one of their arms, certainly does not help the cause at a current scenario. No doubt crude has come off, but I think with the currency being elevated and most importantly, they not being able to manage their non-fuel expenses well, I think it's not going to help their cause. As such, we have seen pressures on yields for even market leaders like Interglobe Aviation, SpiceJet. Jet is, I think, no way is going to kind of come ahead and compete. Rather, they're going to lose their existing market share. So I think it's a total avoid. One should not really hope for a sort of a turnaround in a story like Jet. It's better to play the story if at all one wants to be invested over the long horizon in players like Interglobe Aviation on declines and SpiceJet.
Interesting. Okay. As 8 minutes are about to come to a close, we see some weakness in Kotak Bank. That's likely to start off about a couple of percentage points lower. And commodities, by and large, look like starting off on a weak note. Vedanta, Tata Steel, Hindalco, all of them look like they will start off weak in the session today. Well, Rahul, I was looking at the stock recommendations that you made. While it's large caps and yes, and L&T, not seen a call on the commodity names. Just wondering, what's the trade, a possible trade on a Vedanta, Hindalco, or a Tata Steel?
I am very clearly focusing on the heavyweight stocks, clearly because I think we're at a fulcrum point on the index. So we really need to look at them. So Tata Steel, One of the things noteworthy is the fact that the trading volumes that we saw day before were the highest that we've seen in over 1 year, single day's trading volume. So that is showing us a lot of interest coming in at this price level. Now, how am I reading it technically? We've already had this run up. When we look at various indicators, I think what we clearly want to see over here on Tata Steel is we maintain above 582, 583. Unless we do that, this thing is not going to go on further. So I'd keep 561 as a key level on the downside, breaking which I'm more than happy to even short the stock. But otherwise, for now, maintain your bullish stance and further ignite it beyond 582, 583, as I mentioned.
All right. Sameet, Yash earlier on highlighted the negative MACD indicator for Bank of Baroda. Do you witness further downside on the counter, and to what levels?
See, recently we witnessed, massive, rally in this counter from the levels of 115, 120, and this, rally was backed by strong volumes. And since last, 3-4 days, the stock has come off a bit on lower volumes. So I would say that, the overall trend remains bullish, at least in the near term. So any dip from current level would be a buying opportunity according to us. So in case if the stock, dips down towards say 140, 138, then it would be a buying opportunity, and we would be seeing the stock, heading towards 155, 160 quite soon.
Okay, that's Bank of Baroda. They're dipping about 0.5% in pre-open, 145 on the stock. Parthiv, the IT pack as a whole, in light of record lows for the rupee, what would you build in?
Absolutely. I think as such, the tailwind for entire IT pack was good spending, good economic traction, and with the rising yields in the US markets, I think the banks out there increasing their spending budgets. So the deal pipeline for most of the IT companies, and even after Q1, most of the managements were very upbeat about FY19. And now with the rupee depreciation certainly helping their cause. So I think it's definitely a couple of tailwinds that these IT companies have. And we've seen, I think, likes of TCS, how well it has done, Infosys, HCL Technologies. And I think certainly, especially if I have to look at the second best, I think, IT stocks in terms of the large caps, Infosys and HCL Technologies, they are still, I think, way undervalued as compared to, if I have to compare with valuation that of TCS. So I think that is the strategy one should look at. Infosys and HCL Technologies, I think they certainly have a lot of catch up to be done in terms of the valuations that TCS owns. No doubt TCS is class apart in terms of the earnings, the momentum it has had. But I think even these two companies should do extremely well. And amongst the mid-cap IT, I think a company like Persistent System can really outshine, and that also can play a lot of catch-up, and it has a fantastic customer set deal pipeline, and the lumpiness in the IP revenue, which now can be mitigated for the rest of FY19, can really add back to the earnings. So I think these are the stocks in the IT space where I feel one can make as a basket and play it out over the next 2 to 3 years.
Seeing most of these doing rather well in the session today. Can't say the same for the currency though. Minutes away from market open, let's tell you all that you need to know to stay ahead in trade today. A setback to Kotak Bank promoter. The RBI has rejected the plan for dilution of the promoter stake.
Cash-strapped Jet Airways may just get a new lease of life. Bloomberg reports that Blackstone is in talks to acquire stake in Jet's royalty plan, Jet Privilege.
Amongst companies who reported the first quarter results, Dilip Buildcon, Suin Life Science, SP Apparels and Aster DM Healthcare reported a strong quarter.
On the other hand, Cox & Kings, India Bulls Real Estate, GMR Infra and Fortis Healthcare were among companies which disappointed on their first quarter numbers.
In more news from the M&S space, the Economic Times has reported that All Cargo Logistics is in talks to buy a controlling stake in Gati. All Cargo starts off flattish in trade.
And as per a Financial Express report, K&R Construction is in talks with Cube and Brookfield to sell its entire stake in 4 HAM projects.
Finally, metal stocks will be in focus as LME copper, aluminum, nickel fell about 2 to 4% each overnight. Well, that's a bunch of stocks. Just a couple of viewpoints from a trade perspective on Kotak Bank, because that's likely to start off about 2 percentage points lower. Sameet, Chavan, would you go out and trade Kotak today?
I'll avoid let the prices stabilize. The stock has been hovering around its important support since last 4 to 5 days. 1280, 1285, which has been acting as a very strong support, and it is likely to open below those levels. So let's see, first 15-20 minutes quite crucial. If it stays below 1270s, 1265, then probably we could see extension of this correction toward 1250 or 1245 as well.
Any trade on the bank Nifty, Rahul, that you would like to initiate?
See, I'm still bullish on the bank Nifty. I still maintain that 29,100 is probably going to come. Again, this cannot happen overnight, but in a few days we might even be at those levels. So banking surprises are always likely. The main thing to watch within the banking pack is the fact that does the bank Nifty hold 27,700? If we start breaking 27,700, that's going to be a problem. If we start breaking 290 on SBI, that's going to be a problem. But all in all, stocks like Yes Bank, ICICI Bank, they still look fairly solid. No reason to worry just because banking has run up a lot. I think the trend is intact. Keep 27,700 in mind and trade further.
Sameet, any pockets of weakness according to you, and any specific stocks that we could probably look at on the short side?
No, honestly speaking, as of now, we are avoiding. We would rather, if I just look at the mid-cap index, as I've just highlighted, it has already confirmed a breakout. So as of now, we would avoid shorting in mid-cap as well as some of the heavyweights. We would rather use these dips to get into the stocks.
All right, let's quickly run through your top calls. You've got 1 minute to market opening. Rahul, let's start off with you.
I think I'd look at SBI, again 297, 290, very key levels. I think a breakdown of these levels is really going to give us a nice strong move, very strong volumes locked in within this range. So I'm going to be watching this stock very, very carefully for a breakout.
Sameet?
Both Vokad and Amara Raja looks good, but if I have to pick any one, I would go with Amara Raja, which has come out of its consolidation. So Amara Raja can be bought for a target of 900, stop loss at 814.
Okay, Rahul, Mohindar, as well as Sameet, Chavan, thank you so much, gentlemen, for joining in today and giving us your perspectives. Parthiv, just stay on. We'll take in one opening thought from you. But here's 20 seconds before the market shut shop, or rather market start off trade. Be interesting to monitor how much weakness comes in post the 1/3 of a percent downtick that we'll see, are likely to see on open. The Nifty Bank might well lead the charge downwards, but interesting to see if there's further weakness after the mute opening. 1/3 of a percent for the Nifty for sure. The Nifty Bank, the principal culprit, 200 points down, 3/4 of a percent. Quickly weakening, 0.5 percent now for the Nifty and the Sensex. So the start is not the strongest, but on expected lines, to be honest. Remember, we had an off day yesterday. The global markets haven't been too supportive. Mid caps and the small caps. Ignore the small cap index, 0.5 percent for the mid cap index. This will correct soon. Bring up the heat map, maybe more red than green on the screen. Definitely more red than green on the screen. Commodities stumble. Vedanta, Hindalco, Tata Steel amongst the principal losers. And Kotak Bank out there, a stock in news, which is down about a couple of percentage points. Interestingly, Yes Bank starts off on a weak note. So do watch out for that. Rahul had a strategy there, but starts off on a slightly weak note. What's gaining? Well, the commodity stocks which tend to gain with the crude price downtick. So BP, HP, IOC starting off on a fairly decent note, and Sun Pharma continuing from where it left off in Tuesday's session, about 1% higher. But perceptibly more weakness, and commodity stocks likely to stay weak for better part of the trading day today. What about specific pockets in trade? Let me quickly highlight a couple of themes before I hand it over to Devina for the broader markets. Jet Airways firmly remains a stock in focus. Let's see how the stock has started off about 3 percentage points higher. Blackstone in fray to acquire a stake in the loyalty program as per Bloomberg News. This stock 3% higher in trade. What about stocks that might be reacting to their numbers? The strong numbers by and large from all of these three, but muted start. Aster just about 1% and Dilip Biltcon about a couple of percentage points higher. Well, then let's take a look at stocks which are trending and trading close to their life highs. AB Fashion, UBL, NIT Tech, well, a muted start for each of these as well. I'm not striking any luck with big movers. Devina, what are you spotting?
Actually, in today's session, it will be pertinent to look at what's been causing pain in the market, and the broader market is no different. Mid-cap index is down about 0.4%. Stocks like Cox & Kings down by 4% on the results. JM Financial is down 2%. Shrey Infra, Suven Life, PC Jewelers is down 1.7%. Marlin FS Transport is down 1.6%. Aban Offshore, that stock's trading at 112. ACC at 1543, down 1.2%. Dena Bank loses some steam as well, so there is pain in some of the smaller banks. Capital First is down. Indian Bank is down 1% plus. Adani Enterprises at 200. Oriental Bank is down about 1%. You've got Infibeam, GSFC, which is trading under by about 0.8%. Balrampur Chini, Greaves Cotton, J&K Bank, Allahabad Bank, McLeod Russell, 0.5% apiece. On some stocks with volumes, you've got Rain Industries trading higher by 5%. 1% Beverages, 136 on the stock is up 4%. You've got Dilip Bitcoin, Coffee Day, which is at 253, and strong volumes on some of these stocks.
Okay, Parthiv, before we thank you, the top gainer on the Nifty 500 is Gati. Lots of talks of M&A there. Do you track this counter?
Yes, it's purely because of the talks of M&A part. I think in terms of the results that Gati has shown, I think has been quite lumpy, not very encouraging. I think in the same space, I feel that one should look into a stock like Mahindra Logistics. I think fantastic set of numbers, and I think their dependency on the Mahindra only business is slowly and gradually coming down. It's a stock which is like an asset-like kind of a business model in third-party logistics space in I think the segment, and overall the growth trajectory looking quite good. The margins are slightly lower than many of the peers, but slowly and gradually they are also inching up. So I think a name like Mahindra Logistics and even something like a TCI Express, I think the management is quite upbeat in terms of the long-term growth. And they've been showing fantastic set of numbers irrespective of any sort of disruption that took place in terms of GST in many of the existing listed players. So I think as compared to Gati, purely based on fundamentals, the business model and the growth trajectory, I find these two names far more compelling.
All right. Thanks a lot for that, Parthiv. Appreciate you taking out the time and sharing your views. Let's get in one more voice then. Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, joins us on the show right now with his views. Mihir, thanks very much for joining in and good morning to you. Lots been happening across the globe, bearing down its impact on our markets as well. You've got the currency in a tizzy, commodities have sold off, equity markets now somewhat, though we've been resilient, we can't probably withstand the collateral damage of what's been happening globally. What's your sense?
Yes, I think the next few weeks are going to be challenging, given all the moving parts that are there locally as well as globally. Locally, of course, we had the trade deficit data, which also doesn't look very healthy. So on the whole, I think it's going to be choppy times for equities as well as the fixed income as well as currency markets. So I think all markets are in a tizzy, I would say, and better to wait it out and see how all this pans out in the next few weeks.
The trade deficit numbers closer to 5-year highs. Do you see that building up more pressure for the CAD and the currency, in that sense?
Yes. The other thing to remember is that we have seen a lot of fixed income portfolio flows in the last 4-5 years because our real interest rates have been quite high, and we are beginning to see the reversal of those in the last few months. So the trade deficit combined with sustained FII flows from debt and equity may put further pressure on the currency. So that is something that we need to watch out and see how the RBI responds to that.
Mihir, good morning. Neeraj here. Assuming with an assumption that even if the RBI intervention were to come in, the natural course might just take the rupee slightly lower. I mean, it's a hypothesis, but if we work with that hypothesis, what's the impact that it has on markets by and large? I mean, I know foreigners by and large, even despite the 12% uptick on the Nifty, wouldn't have made any money with dollar-denominated returns. The same is not true, of course, for you guys and the domestic mutual funds. But what happens if the currency were to weaken further?
So it's a question of the trajectory, I would say. If the currency weakens in a steady fashion, I think it's fine because people can build for it, people can hedge and kind of account for the hedging costs when they are looking at Indian equities and fixed income. So that's fine. It's when you see volatility and sudden movements in the currency, that's when people kind of stop and reassess what they need to do with the long-term view in the country. So I think a steady depreciation is fine because we are running a current account deficit all the time and a trade deficit which is much larger. So having said that, the currency should naturally weaken over a period of time. So it's a question of whether it's sudden, like a shock, or whether it's more moderated and controlled.
Mihir, in which case, what happens to the big elephant in the room, and that is crude? If that were to turn around, I know it's been soft over the last one odd month, but very choppy and volatile. If crude were to worsen, are markets now extremely vulnerable? Yes, the earnings are strong, but we are perched in or around the new highs with the currency at 70, 72 as the case may be. If crude were to make a comeback, does that make our markets extremely vulnerable to some downsides?
Oh, absolutely. I think crude is the single biggest variable for India. Whether you look at the fiscal deficit, the trade deficit, the inflation number, the currency situation, the fixed income markets, it's ultimately directly or indirectly all linked to crude. And thankfully, from the peak of 80, it's stabilized at closer to 72, 73, and hopefully it won't go up any further. Having said that, there is a good chance that given the ultimate potential supply of shale, etc., we won't see upside rather than compared to a downside. So I think if you were to ask me, the probability of crude stabilizing and drifting a little lower is probably higher in the next 1 year or so than it going to 80. Fingers crossed, of course.
All right, that works. 71% of the jump in the deficit this time around was because of the crude oil imports. And remember, currency playing a very important role, at least on this side, because every 1 rupee change against the dollar hurts the import bill, the crude bill, by $1.58 billion. So, that could overall have a big macro impact. Coming to markets, and the kind of activity we've been seeing on the foreign investment side, the pickup has been recent. You've not been seeing them in the markets for a really long time. Recently, they started to pump in some money. Do you see the allocation to emerging markets increasing from the foreign money side?
As far as the recent few months are concerned, we are seeing outflows continue from emerging markets, both in equity funds as well as in bond funds. And that, I think, is a broad function of rising US interest rates and the fact that the US equity markets are doing quite well. So to the extent that we believe that the US is still on a rising interest rate path, we might continue to see weaker FII flows than before for the next few months at least.
Mihir, earnings by and large, save for SBI, we're just doing that piece this morning. If we remove the SBI exceptional loss, the actual EPS for the quarter, bang on in line with what the estimates were at the start of the quarter. Has it been heartening for your coverage universe or the companies that you guys are invested in?
Yes, so far the earnings trajectory is still in line. Though having said that, we have seen downgrades over the last 6 months at least. So hopefully by this quarter we won't see any further downgrades. So I would say that yes, mostly the private sector has done well, while the public sector overall has not done so well. That's been the trend so far.
But your conversations, Mihir, with companies or the calls that your team would have analyzed, do they give you confidence that leading into quarter 2, quarter 3, while the reported numbers might be lower than quarter 1, but it's broadly in line with what you guys were anticipating?
So far it looks like yes, especially on the consumption theme, which continues to remain strong. So if we look at the private sector financials, which are catering to a lot of consumption demand, NBFCs as well as private banks, if you look at automobiles, etc., it looks like the trends are still broadly in place for the consumption theme. I think we might see a little bit of tapering off from the infrastructure-led pack, not so much on the earnings, but from the incremental order book growth for the next couple of years. So that's something that we need to watch out, whether the strength of government spending continues or it's wearing off.
What did you make of the entire banking pack earnings? And now that we're looking at big heavyweights like SBI actually upfronting most of their provisions and saying that the next few quarters to come will actually be positive since they've already upfronted most of the provisions.
Yes, so as far as the corporate-led or corporate-biased lenders are concerned, probably on the private sector side, the worst may be over, and we might see some return back to growth by those banks. So that is one trend we probably should watch out in the next quarter or so. And the retail segment continues to do well. while growth continues to be robust, we are not yet seeing any major signs of stress on the small ticket retail. There is some inkling that the SME segment might be seeing stress in pockets, but probably it's too early to take a call on that.
The consumption theme this time around playing off well, according to you?
Oh, absolutely. I think that's the only theme, apart from, as I said, government-led lending, that's holding up the economic growth. Capex is still not picking up, and the whole host of segments linked to consumption, like the private sector NBFCs, private sector banks, automobiles, paints, affordable housing seems to be doing well, and we are seeing a lot of action. So probably you might see some pickup in cement demand because of that. So yes, I think the consumption theme as a whole is still robust, and I expect it to remain robust because of the election year syndrome. We don't expect government to let loose on the feel-good factor for the consumer, at least till the elections are over.
It's an interesting point you raise up, Mihir. Cement, the numbers chalk and cheese this quarter, save for the Wholesome Group. The others didn't quite live up. And well, the theory, at least about a quarter ago, was that the big demand push that will come in for cement has gotten pushed by a year at least, if not longer. Are you getting the feelers that the demand may surprise on the upside, if not in quarter 2, then at least starting quarter 3 onwards?
Yes, and it may largely be linked to the affordable housing pickup. So, as I said, there is good pickup on the affordable housing, especially on the rural side. And if that trend continues, you may see some upside surprise. Because if you look at the aggregate cement demand, bulk of the demand actually comes from housing. It's not so much of government capex, etc. And of course, a lot of it is rural housing. So if rural housing and semi-urban housing picks up because of the government scheme, and there are some signs that it is, then you might see cement demand getting robust as we go forward in the next couple of quarters.
Commentary bullish from IT by and large, Mihir. Add to that the rupee tailwind, and I believe the presumption is that natural slide of the rupee is underway as well. Do all of these factors augur positively for the listed stocks?
Yes, the currency of course will help the EPS expectations, but more importantly, in volatile times you anyway see people switch to defensives, and IT is considered to be a defensive. So I think in times when we are seeing uncertainty on flows, on currency, it is natural for the markets to move to FMCG, pharma, IT kind of segments, and that's what we have seen in the last few days.
With what the crude is doing and what the rupee is also doing, you think it'll have a meaningful impact on some of the oil marketing companies?
Oil marketing companies, we used to like them a lot, and of course we've kind of suffered a bit because of that. The problem is that there is complete lack of belief on consistency of probably policy towards these companies, and that's the reason why these companies have seen a significant derating in the last 6 months. So even though marketing margins may be robust at this point in time, markets are not convinced that these margins will continue or will be allowed to sustain. That's the reason why you see the entire OMC pack as well as the government PSU upstream pack also not really participating in any form in spite of crude prices moving either ways.
City burden will weigh down on them?
Sorry, come again?
The subsidy burden for some of them. Do you think it'll be large enough for them to actually see a meaningful dip in terms of the share market prices?
So that's the issue. The market doesn't know what the final policy on subsidy sharing is going to be, because beyond 70-75 the required increases in petrol and diesel prices have been kind of not so automatic, and that's the reason why the market is concerned whether they'll be able to withstand a further upside shock on oil prices. That's the reason why we see oil marketing companies not really correcting upwards in spite of oil having corrected from 80 to 72. So marketing margins theoretically have increased, but people don't know whether these margins will be allowed to sustain.
Okay, Mihir, appreciate you taking the time out and being with us today. Thanks so much. I look forward to have you, of course, more often on this forum. That's an important market voice. Mihir
Thank
Vora
you. Always a pleasure.
Of Max, talking about his thoughts on the markets. The trade deficit, a clear worry, but a natural slide down on the rupee might not be too big a worry. Well, the market's about 1/3% in the red. The Nifty Bank, 3/4% in the red. Take a quick break on that note. We'll come back from the break and talk about the first quarter earnings and the expectations from the rest of the year with Jitendra Gohil of Credit Suisse and Shibani Sircar Kurian of Kotak Mahindra Asset Management.
City Union Bank, trust and excellence since 1904. City Union Bank, wishing you a happy Independence Day.
Dreamers, they're everywhere. You've met them, been to school with them, worked with them. They didn't seem different. Yet she's the one who surprised everybody. His crazy idea actually worked.
They are no different. They are you when you take a chance on yourself.
These are the dreamers who found a way to run the engine of the world. These are the entrepreneurs. There is no formula. There is no right place, right time. There are no overnight successes.
But there is toil, there is preparation, and there is tenacity.
There is no end of the road, no obstacle large enough. There's just the vision and the heart that won't give up.
Because Agons of business never stop.
Agons of business never stop. Only on Bloomberg Quint.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
You're watching Indian Open right here on Bloomberg Quint. The first quarter earnings have drawn to a close, and there's been a fair share of companies which have beaten street expectations as well, as I said in the morning. But what's perhaps a bit disconcerting is that all-round earnings recovery has maybe been a bit elusive. Though, save for SBI, the Nifty numbers seem to be largely in line with estimates. Should one take hope from these numbers and expect a better time in the quarters ahead? Joining us now to talk about this are two experts. Joining us from Sydney is Jitendra Gohil, the head of India Equity Research at Credit Suisse, and Shibani Sircar Kurian of Kotak Mahindra AMC with us in Mumbai to help us decode the numbers and the trends that stand out. Both of you, good morning and thank you so much for joining in. Jitendra, let me start off with you first. If we remove that exceptional loss, or rather the loss number from SBI, which came as a bit of a surprise to most people, 120 kind of an EPS, which is bang on in line with what the Bloomberg consensus was at the start of the earnings season as of July 10th. Has this lived up to what you were working with? And has the commentary from companies, which you guys at Credit Suisse track, been in line with what you were estimating?
Yeah, of course. I think if you look at consumption sector, which we have been bullish on, I think pretty much it was in line, or rather better than our expectations. So I think that sector we were really bullish on, and that sector has delivered. As you mentioned, barring one or two companies which have actually reported, less than expectations, but I think overall, generally, we are positive on the micro recovery, and that is what exactly we have seen in Q1. So I think it's largely in line. What we are expecting is on the future couple of quarters, I think now we will be looking at almost like a festive season demand, which will it is going to be robust in our view. And commentary also from the management was that the rural is recovering, which is also supporting our view on overall recovery on the consumption side as well.
Interesting. Shibani, what about your portfolios? Did this live up to your estimates? Because if I just look at the Nifty 50, save for select private sector banks, by and large, and maybe autos, by and large, the numbers seem to be in line or better than what the Bloomberg consensus estimates were.
Yeah, hi, good morning. And yeah, you're bang on. This quarter, after a long time, we've seen that most of the companies have either met estimates or have delivered numbers which have been better than estimates. So the pace of downgrades that you have been seeing over the last few quarters has certainly come off. And like you mentioned, if you strip out a couple of the public sector banks and some corporate banks, if you look at the overall Nifty earnings trend, this has been fairly strong, double-digit kind of an earnings trend. This bodes well for the remainder of the year and in terms of earnings estimates for the year as a whole, which is FY19. Internally, what we have baked in is about mid-teens earnings growth for FY19. And on the ground, when we are interacting with management and also management commentary during the results season, seems to clearly indicate that on a micro front, demand recovery is back on track. So if you looked at clearly sectors which include consumption, both discretionary, non-discretionary, retail, private sector banks, NBFCs, cement to some extent, all of these sectors have delivered fairly strong numbers. Volume growth pickup is clearly visible across consumption and consumption-oriented sector, which bodes well from the theme that we have been talking about over a period of time and which has been a dominant part of our portfolio. So yes, I think that going into FY19, the first quarter does bode well and sets the tone for the remainder of the year.
Interesting. Okay. So let's try and dissect these numbers. Now, Shibani, I'll come to you first. Since both of you are talking about consumption, looking at the numbers, ITC, HUL in line with estimates, Bajaj Finance to a large extent, consumer finance in line with estimates, Titan, Asian Paints, much better or very strong numbers, slightly higher than what the street was working with. You couldn't have put a foot wrong if you were invested in the staples stroke consumption space. The question is, are the valuations extremely stretched, or does the growth provide room for these valuations to stay in the same way for the next few quarters?
So yes, valuations clearly are not in the attractive zone where consumption stocks are concerned. However, what we see that overall there are three key themes that are driving the overall demand and the volume growth that you've seen, especially in the first quarter. One is that the rural segment is now showing signs of recovery. Last few years has seen that consumption growth was essentially led by urban consumption, and now that is getting supported by rural consumption, and that trend we believe will continue. Second is premiumization, and that is also visible in terms of numbers that we have seen where clearly the trend of premiumization is catching on. And third is of course the overall theme where there is underpenetration and low consumer leverage, and that leverage is starting to pick up and which is showing through in terms of numbers that you've seen, especially for some of the retail financing names that you mentioned. So overall, if you look at these three key themes which are driving consumption growth and volume growth, that we believe will continue. And if margins do support, the entire operating leverage will start to play out and you will see stronger earnings growth. Yes, clearly valuations are not cheap and they have moved into a slightly stretched zone. But as long as the earnings growth and the operating leverage really plays out, I think that it is possible that consumption as a theme could remain dominant and the key driver for earnings growth for the market. And it's not just consumer-specific stocks that we are looking at stocks especially in the retail private sector play, certain select NBFCs, auto automobiles in certain pockets. So it's a clearly large kind of a sectoral theme that would possibly be the key driver for markets going forward.
Sure, but I would want your view on some of the earnings of these pockets that you spoke about, Shibani, as well. But Jitendra, before that, an offshoot of consumption has to be autos. What did you make of the earnings that came out from the auto space this time? Because, I mean, if I just look at the Nifty, Jitendra, save for Mahindra and iShares, the others seem to have come out with a weak quarter.
Yeah, I think yeah, we were expecting autos to do well, but actual earnings actually disappointed us to a certain extent. Basically, in two-wheelers, we are experiencing some kind of competitive intensity, which is actually leading to margin compression. On the growth front, I think we are very bullish on tractor front, and that is doing pretty good. The third is our auto anchs. Possibly we were looking at slightly stronger results because of the global growth, but Indian exporters are seeing some kind of pressure on margins as well. So results were pretty mixed, but we remain pretty confident about recovery in H2. So we think that auto companies are the sector that one should look at before the festive season kicks in, and also if the monsoon is better, probably the two-wheeler demand will also be strong. There was some negative news on the CV cycle front because of the changes in overloading norms, but I'm not very much concerned because generally CV cycle is linked to the domestic growth, and also the GST has been fairly now in line. So I think we will see CV cycle to remain pretty strong in our view. So I think overall auto space we are pretty okay. In terms of auto financiers, I think that's the interesting space, and we think that despite higher interest rate scenarios, I think NBFCs which are catering to auto financing, there is some room for further rally, I guess. So I think overall, from an auto financing perspective, two-wheeler, four-wheelers, I think we are pretty much in line with our view that it is going to be kind of a recovering cycle overall in the next couple of quarters.
Jitendra, Shibani, I'm not asking you guys to give me a buy, sell or a hold recommendation, but more a view on what the earnings of these specific companies look like. And on that point, Jitendra, just sticking to the auto theme, does Tata Motors continue to disappoint? I mean, the reported numbers this time around as well had a lot of chinks in the armor.
I can't specifically comment on one company, but as I mentioned, if you look at overall four-wheeler market in India, it is looking pretty good. So the recovery is on our way. We are looking at somewhere a mid, 10 to 15% kind of a growth in numbers. So the four-wheeler industry as a whole is doing pretty good. So I think exporters, there is also a problem with the currency fluctuations, also mark-to-market losses. So I think there could be some kind of disappointment on that front. But our global view is that the earnings and the outlook for GDP globally is going to bounce back in H2. So probably some of the exporters could also see recovery in the next couple of quarters.
Okay. Shibani, what did you make of the cement earnings? Say for ACC and Ambuja, the larger portion of the large cap cement space as well as the mid caps, I mean a clutch of mid caps out there which came out with the fairly disappointing numbers, at least based on the estimates that we had. What did you make of these numbers?
So I really can't comment specifically on companies, but I will comment on the industry as a whole. What you've seen in cement is that volume growth pickup is now visible after a fairly long stagnant period of time. What has been the key disappointment has been the pricing improvement, given the fact that most companies have seen improvement in capacity utilization, demand and volume growth is clearly picking up. One would have expected that pricing would have also picked up, and therefore that would have resulted in better numbers in terms of profitability, which has really not played out. And that's where the disappointment has been. But the very fact that pricing growth has not been visible is possibly because of a few large players trying to gain market share. And our belief is that is now coming to a fag end. And as we exit the monsoon season and as volume growth continues to pick up pace, some of the pricing improvement will also start to flow through. And therefore, the operating leverage that you see in terms of better profitability and numbers for cement companies should also start to play out over the next few quarters. So I think cement we are positive on as a whole, and like I said, it's been a very, very long period of time after which we have seen demand actually start to pick up, and it's a matter of time when pricing growth will also start to flow through, and clearly that leading to better profitability and better earnings growth for the sector as a whole.
Interesting. Now we've had two voices today. We've just spoken optimistically about cement. Mihir, Vora earlier was referring to some green shoots out there as well, if not in Q2, in quarters ahead. Shibani, what about the commentary that came in from the IT companies? Because on the reported numbers, TCS was probably, to my mind, the only one which did well. The others were lackluster or fairly muted. But what did you make of the commentary? And coupled with the rupee tailwind, does it look like the reported numbers in the quarters ahead could live up to expectations or better than estimates?
So I think IT is a sector where you are seeing green shoots of demand improvement. It's not a runaway improvement in demand. Clearly, there were two key issues with the sector. One, of course, the overall IT spend from some of the larger players had come down, and that was muted. Secondly, there was a trend of insourcing that we had seen, which resulted in lower growth for the Indian IT services players. At the margin, we are seeing signs of demand pickup and some of the spend coming back, especially with larger banks, both in North America as well as Europe. And that is also reflecting in commentary with regards to BFSI, and therefore it is a belief that demand growth has bottomed out and you will start seeing improvement. It's not going to be significantly high runaway growth. You will possibly see high single digits to low double digit kind of revenue growth for some of the companies going forward. Clearly there will be differentiating factors depending upon what kind of deal wins each company is able to get, and that will be the driver. In terms of the rupee, clearly the rupee is a tailwind, but what's happened in terms of margins for IT companies over the last few years where revenue growth has been muted, most of the companies have utilized some significant amount of margin levers, and therefore from here on, for margins to stay stable or to improve, automation would have to clearly play a big role, and cost cutting and or cost efficiencies would have to also be seen for companies to maintain margins. In this sort of a scenario, rupee clearly is a tailwind, and that would help companies maintain margins. But as revenue growth picks up, some of that would also flow through in terms of earnings. So I think in terms of downside protection, clearly from a valuation perspective, and also given the fact that these companies are clearly great generators of cash, a downside seems to be protected. And from here on, as demand starts to improve, we would start to see some improvement in terms of valuations, especially for the large cap IT players. The mid cap segment has already seen a fairly significant run up, and you've seen valuations in pockets now looking stretched. So I would be fairly cautious and stock specific on the mid cap IT players.
Well, interesting. The stocks continue to move up though, maybe sentimental or otherwise, but the valuations clearly much higher than what the large cap peers are pointing towards. Maybe the growth numbers looked okay too. Jitendra, I look at the private financials and just the reported numbers, not really the outlook on the stock, but the reported numbers. Axis Bank meeting estimates, or maybe better than what the street was working with, but the reported numbers of HDFC, Kotak, as well as ICICI Bank below what the Bloomberg consensus was. Is it one small quarter of a miss, especially for Kotak and the HDFCs, and do you reckon that the trajectory ahead on the reported numbers could be better?
I think it could be a good buying opportunity. We are not very much concerned about this marginal miss. That was partly because the NIMs were under slightly pressure because of a higher interest rate, and plus they have seen slight losses in their treasury book as well. But I think overall the trajectory of growth is pretty much intact. They are making new headwinds in the newer areas. They are expanding their operations. So overall I feel that despite some kind of pressure on margins, declines on NIMs because competition is also improving. But I think we are not very much worried about that space. The only concern could be some of the private lenders where market is now expecting that from here onward the NPA resolutions will be on a fast-paced basis, and we might see some kind of improvement on that aspect. We are not very much looking at that number as well. We are pretty confident on the growth side, so we prefer retail-oriented private sector banks. In terms of NBFCs, we like HFCs. Housing finance companies have reported a decent set of numbers, so we like that space. But we have to be very selective on that as well, because we think that after such a strong growth numbers for the past couple of years, we might see that slight pressure could be seen on the NPA front as well. So you have to be selective in NBFC space, especially on the housing side. As I already mentioned about the auto financiers, that we are pretty much confident. There's also some important understanding on the SME side. So SME financiers also would see some kind of pressures on NPA side. That's what our view is. But as of now, we are not looking very deeply into that space as well. But overall, I would say that private financials is looking pretty strong. Growth is somewhere close to around 20-odd%. So that's a decent number to work with.
Does it make sense to look at the reported numbers, Jitendra, for the telcos? I mean, Jio doing what it is doing, but Reliance's numbers largely driven by what the Petchem divisions did this time around. And Bharti and Idea in particular, we all know what happened to the kind of quarterly performance. How much of an importance would the next couple of reported quarters be for the listed telcos?
See, in my view, we are staying away from telecom companies because the tariff war is on, and until and unless they all settle down with their comfortable levels in terms of their market share, we don't see that that sector will do well. So I think telecom we are slightly avoiding, despite robust opportunities. If you go and buy some of the telecom companies, there is some chance that you'll not make money. So I think we are staying away from telecom space as a whole, but we are very positive on the penetration front in terms of data penetration, in terms of growth. We are positive, but we are not currently investing in these companies because we expect that further pressure is still there till the time they settle down with their market share as a whole. So we are not looking at telecom as of now.
Okay. Shibani, my final question. What stood out as a surprise, positive or negative for you, out of this earnings season?
So I think this earnings season was more or less in line with expectations. So I think that's the key takeaway. I think what I was really looking for is whether there would be significant downgrades to earnings estimates for FY19. That has not really come through, and that's a positive in my view. And therefore, it gives us some sense of stability that mid-teens earnings growth is clearly on track. And if earnings really plays out, given the fact that valuations are slightly stretched as earnings starts to pick up pace, that gives you some sort of comfort and protection in terms of the current market, which is clearly seeing volatility given the kind of macro issues that are there. So I think my key takeaway from the earnings was that now the pace of downgrades is coming down across sectors and across companies, and therefore more visibility in terms of full year earnings estimates, and that's been the key positive from the earnings season.
Okay, both of you, thank you so much for taking the time out and joining us and giving us that perspectives. Really appreciate your time. Jitendra, thanks for traveling to our Sydney studios for this interaction as well. But with that, it's a wrap on this leg of Indian Open. Keep in mind that the markets have recovered a little bit of lost ground. The Nifty Bank is just about 1/3% in the red now. The Sensex muted. So, well, contrary to popular belief, the markets, while they started off weak, haven't continued in the same vein. They've actually recovered quite a bit. Just want to mark Kotak Bank individually and just see what that stock is up to, because remember, that was believed to be the one that will start off weak and weaken further, and it has. 1254 now, 3% off. So in addition to the commodity names, Kotak Bank is that one principal drag on the Nifty Bank, and which is also kind of putting that little bit of pressure on the index. But I'm sure the FNO show will take forward all of this activity. So a wrap on Indian Open. Up next is the FNO show. Stay tuned for that.
City